This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 407 was produced on December 21st, 2023. I'm Eric Townsend. Bianco Research founder Jim Bianco returns as this week's feature interview guest. We'll discuss the FOMC's about-face on monetary policy, why it happened, and what comes next. But Jim says peak yields are not behind us, and that more turmoil still lies ahead in the bond market. This will be our last regular format show of 2023. In keeping with MacroVoices tradition, we have two holiday special shows lined up for the next 2 weeks, and I think you're really going to love the long-form content we've lined up for you over the holidays. Next week, my guest will be Lynn Alden, and our topic will be Broken Energy. That's the title of a book I suggested Lynn write to complement her current bestseller, Broken Money. Then a week later, on January 4th, my guest will be Radiant Energy founder Mark Nelson, and the topic will be a deep dive on advanced nuclear technologies and what they mean to the future of nuclear energy. Both are long-form interviews ranging from 90 minutes to 2 full hours in the case of Mark Nelson's interview. But there's homework for you to do before the January 4th episode. Mark and I are going to take a deep dive on molten salt reactors, liquid-fueled reactors, thorium, pebble bed reactors, and much more. But we're going to assume you already know the basics of what causes core meltdowns and hydrogen explosions, what a molten salt reactor is, and so forth. All the prerequisite background material you'll need to know in order to understand Mark's deep dive interview is contained in episodes 5, 6, and 7 of my Energy Transition Crisis docuseries, which you can watch for free at energytransitioncrisis.org. So unless you're already somewhat expert on nuclear energy, I recommend watching those 3 episodes before listening to Mark's interview on January 4th. I also have a brand new video coming out explaining how advanced nuclear SMRs could solve energy transition for less investment than has already been spent on renewable energy. That video should be released alongside next week's interview with Lynn Alden and will be linked in next week's Research Roundup. Meanwhile, you can get a taste of that material from my video interview this week with Dr. Chris Martenson of peakprosperity.com. That interview is available now and is linked in this week's Research Roundup.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, December 20th, 2023. The S&P 500 March futures contract was down 23 basis points, closing at 47.49. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The U.S. dollar index down 49 basis points, trading at 102.40. The February WTI crude oil contract up 645 basis points, trading at 74.22. It's a meaningful bounce off the low, but testing some key resistance levels at 75. We'll take a closer look at that chart in the postgame, and Eric will have the EIA inventory data. The January RBOB gasoline up 891 basis points, trading at 220. The February gold contract up 34 basis points at 2,047. Copper up 290 basis points, trading at 390. And uranium up 557 basis points, up to $90 even, printing a new year high as that trend continues. The U.S. 10-year Treasury yield down 17 basis points, trading at 385, now decisively below 4%. The key news to watch this week is Friday's core PCE index, and no major news in the holiday shortened next week. This week's feature interview guest is Bianco Research founder Jim Bianco. Eric, why did we invite Jim back on as a guest this week?
Well, Patrick, this is our last show of 2023, and I always like to get a rock star guest for the last show of the year. Jim is one of my favorite macro guests of all time, and his focus on fixed income is a perfect match for decoding last week's FOMC statement, which rocked the markets. Jim has also introduced a new index, which WisdomTree has already launched an ETF to track, so we'll cover that news as well.
Well, Eric's interview with Jim Bianco is coming up. as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Erik Townsend.
Joining me now is Bianco Research founder Jim Bianco. Jim, it's great to get you back on the show. It's been way too long. I have been just thinking about you ever since Wednesday evening when you tweeted what I thought was one of the most insightful tweets I've seen in a long time about word salad. But just for anyone who hasn't seen that, let me set the stage for our listeners. About 3 weeks ago now, there was first some dovish indications from the Fed that in that crazy Sunday night session sent gold to upwards of 2150 just in the thin liquidity of Sunday night trading. But then it all reversed the next day when Jay Powell basically told the market, look, it would be premature to start speculating at this point about any kind of rate cuts. It's not time for that yet, guys. Don't do that. Then after that, just about every macro data point that came out was tilting at least slightly on the hawkish side. We ought to expect the Fed to get more hawkish at last week's FOMC. That caused gold to sell off. It caused a lot of trepidation in equity markets. Everybody was kind of on the edge of their seat. And then the Fed surprises everyone by not only tilting back to the dovish side, but the dot plots and the messaging out of the FOMC statement all indicate that they're basically announcing that they're getting ready to go to rate cuts, exactly the opposite of what Jay Powell had said just a couple of weeks earlier. Then Nick Timiraos asks Jay Powell a question in the presser saying, how come you kind of said one thing and then said the opposite thing? And as you put it in your tweet, the man who has earned international accolades, Jay Powell, for his ability to speak clearly in plain language that everybody can understand to explain monetary policy decisions, suddenly can't form a coherent sentence to save his life. You called it word salad. What's going on here? How come suddenly Jay Powell, Mr. Clear, concise, and easy to understand, can't explain himself?
Well, I think the simple answer is that he's been asked a question that he doesn't have an answer to. And that's why he's kind of just, word salading all over the place, trying to come up with one. And specifically, the question that Nick Timiraos asked him was, you're right, December 1st, it was premature to talk about, cutting rates. Back in early November, they heralded the sell-off in the stock market and higher interest rates is doing the work for the Fed. And so therefore, we don't have to raise rates anymore because the stock market's tightening financial conditions, higher interest rates are tightening financial conditions. And then almost immediately after they said it, we had a monster rally in stocks and in bonds. Bonds in November had their best month in 40 years. And that continued into December. So what Timiraos was asking him was, what happened to tight financial conditions, Jay? Now they're very, very easy. The market is not doing the work for you anymore. And he didn't have an answer to that. And it's almost like, the cynic in me likes to say that the Fed has kind of made up their mind already of what they want to do. And then they say, hey, look at these indicators over here. And they justify what we want to do. And then you say, wait a minute, all those indicators just reversed. Okay, never mind those indicators. Go look at these over there. And those are the ones that tell us what we want to do. And it seems like he's made up his mind that he wants to cut interest rates or at least end interest rate hikes. It seems like he's bought into the narrative that inflation was indeed transitory. It was a one-time thing. It took 3 years as opposed to 3 or 6 months, but that it's transitory and now they don't have to worry about it. And when I say he bought into it, you remember as well as I do, all through 22 and 23, he was channeling his inner Volcker and saying, yes, when inflation comes down, we don't want to ease too fast and we don't want to stimulate the economy and then have another echo of inflation go back up. All that's out the door right now. The Fed is in a very dovish policy. And I might add that if you kind of update it through the day we're talking, it seems like what's been happening is the market has taken his dovish words and it's gone way beyond where he thought it would go, that they're pricing in 6 rate cuts. The market is for 2024, where the Fed dot chart last week said that they do maybe 3. So you've got a bunch of Fed officials, starting with New York Fed President John Williams, and today even Chicago Fed President Austin Goolsbee, coming out and saying, hold on here, guys. We said that we might be done and we might be cutting rates, but nobody said anything about 6 rate cuts yet, that you're getting a little bit ahead of yourself. So they're trying to push back on that right now. But yeah, the word salad is largely because, Jay, the market is easing rapidly. Is that stimulative for the economy? And if that is stimulative for the economy and is going to create a wealth effect, and, to use the crypto term, everybody's going to go out and buy Lambos, does that mean we're going to wind up with inflation in 24? He doesn't want to say yes to that question. He doesn't want to say no to that question. So he kind of word salads his way through the answer.
Okay, so you're saying that they're basically looking for data that will justify what they already want to do. And I agree with that. But hang on, it seems like what they already want to do has changed because, as you said, for quite a while, they were pretty staunchly like, look, we're not done with rate hikes. We're still in fighting inflation mode. What brought them, or what caused them to do an about face so that what they wanted to do was look for an excuse to cut rather than to hike?
Yeah, you're right, because they do seem to have changed. And I would agree with you, or agree with the premise that the data is not really supporting a giant U-turn in the economy right now. Oh yeah, there's all this talk about a soft landing and there's all this talk about a slowdown, but you'd be hard pressed to really find it in the data for now. Maybe it comes in the data, but they're data dependent. They're not data forecasters right now. I think it comes in the structure of the Fed. The Federal Reserve is unique in that they do release vote tallies. So we know who, how many people voted for a policy, and if there's any dissents, who they are. The Bank of England does that. The Bank of Japan does that. The European Central Bank does not do that. They do not tell you what the vote was. Christine Lagarde, when she gives her press conferences, says the members were in favor of, but she doesn't tell you whether what the vote was and who was the objectors. But within the ones that do give vote tallies, they do have dissents. There are 6-3 votes or 5-4 votes within the Bank of England or within the Bank of Japan. The Consensus Society of Japan will have a 5-4 vote among their monetary policy. But the Federal Reserve wants 12-0 votes, or they want 11-1 votes. They pride themselves on that. They think that puts a forceful impetus on monetary policy if everybody agrees. So my take, and this is just my take, I have no way to back this up, is I think that a lot of the newer members that have been appointed by the Biden administration, we do know that from their history that they're very dovish. I wonder if they've banded together and said, Jay, we want to cut rates. And if you don't join us, you're going to have an 8-4 vote. You'll still get to do what you want to do, but it's going to look really bad for you at 8-4. And I'm wondering if he's acquiescing to that internal pressure of that he's got to follow his members, because there's been a lot of members headed by Austin Goolsbee, the Chicago Fed, Lisa Cook. These are newer members that have been appointed by President Biden that have really been very dovish on the Fed and have made no bones about what they want. And then you could throw in, a Mary Daly from the San Francisco Fed wasn't appointed by Biden, but she's definitely in that camp as well, too. And you could see that there's a core of 3 or 4 of them or so that are definitely against this policy of raising rates. And I wonder if he's made the decision that I'd rather it look like it was my idea than to have an 8-4 vote or 7-5 vote for monetary policy.
Now, I notice in that explanation that you're mentioning who appointed each of these members. That's kind of telling to me because I noticed some of the cynics in the market, Zero Hedge and others, have said, okay, look, what's really going on here is this is all about election year politics. This is about the Biden White House pressuring the Fed to say, you better make sure that we don't have any hard landing between now and the election. Is that why you alluded to those being Biden appointees, or why did you say they're a Biden appointee specifically that seemed to be the resistance to the more hawkish tilt that we had previously from the Fed?
No, I think that that's the case. I think that there's a lot of politics that goes on at the Fed right now. And I think that there is politics at the Fed. I was uncomfortable it doesn't matter what I think, but I was uncomfortable with the idea that Austin Goolsbee became the Chicago Fed president. And I wasn't the only one, because typically when a Fed president is appointed, there's a vote by the board. And it's a ceremonial vote. There was some abstentions to his voting him. Now, why was that? Because Austin Goolsbee, while he is an economist at the University of Chicago, so he's a perfectly qualified economist, he was an administration spokesman for the Obama administration. He was a regular on especially right-leaning conservative TV. He was the guy that they would send on Fox News. He was a regular with Bill O'Reilly during the Obama administration to basically support the administration's policy. So he was a talking head for them. And that's where he rose his stature to becoming the Chicago Fed president. And you wonder if he is continuing that type of policy or that type of approach. There's no doubt in all of his speeches, he is one of the most dovish members on the Federal Reserve. And finally, let me point out, be careful what you wish for. Yes, it's an election year. Yes, I have suggested, and like I said, I can't prove it, it's just my opinion, that these members are pushing the Fed to be more dovish going into an election year. And I get it. But if that winds up overstimulating the economy and winds up making inflation stickier than people think, this isn't going to work. You're going to wind up with the wrong reaction out of financial markets and the wrong reaction out of the economy and the American public if we're still dealing with an inflation problem in 2024. So bear in mind that the Fed got the inflation story with transitory completely wrong in 21. They've got the forecast for the economy completely wrong in 22. So here we are at the end of 23, and they're going to basically bet their reputation that they're going to get their 24 forecast correct, that the inflation problem is behind us, that the economy is going to moderate to a soft landing, and that all of that will work for them to cut interest rates. No less than the day we're recording, Bill Dudley, the former New York Fed president, said exactly that in an op-ed in Bloomberg. He said, look, they're staking their reputation on a soft landing and that there's going to be no inflation. And he said, there's real reasons to think that might not happen next year. And then he said, and I hope they're right, because he wants the Fed to be right, but acknowledge that, this is an unknown. So they're staking a policy on that is not obvious that that's the policy that they should be staking.
And I should mention for our listeners' benefit that this interview was recorded on Monday afternoon, just after the market closed. So anything's possible between Monday and Thursday when our listeners first hear this interview. Let's go back then. Let's kind of take a step back from, if we're talking about these decisions the Fed may be influenced politically to make, well, what is the underlying core decision itself? And it seems to me that the real core issue is the question of whether or not market rates have topped. Have we hit peak interest rates or not? I believe the high print on the 10-year was 5.03 and the 30-year was 5.17. Seems like the Fed is basically going all in, maybe with some political pressure pushing them there to say, okay, that was it, guys. That was peak rates. We're not going above 5.03 on the 10-year. Can't happen. It was transitory. It's behind us. Nothing to worry about. Let's get out of speculating about the Fed and into your personal view, Jim, as a market analyst, macro fixed income guy. Is 5.03 on the 10-year, is that the never going to see it again, or is that actually still up for debate?
I think it's still up for debate, and I'm still sticking with my forecast for 24 of 5.5. Now, I know it hasn't been working for the last several weeks here, that there's been a giant rally in the bond market as I've been trying to make the case that, ultimately they've been in a very strong uptrend. Yields have been since 2020. And I don't think that uptrend is over. Now, the reason I don't think that's the case is because as I look at the economy, I see signs of resiliency and I see signs of strength. And that resiliency really shows up in a couple of different places. Let's start with GDP. GDP has been running at or above trend now for 5 or 6 quarters. The third quarter was 5.3% GDP growth. That's booming growth. That is flat out boom. And now we being everybody, expected it to slow down. And so that's not a surprise. If we kept going at 5, that would be a big shock. But so far, if you look at the Atlanta Fed GDP Now tracker, for those of you not familiar with it, the Atlanta Fed does what's called a GDP tracker. I like to use the metaphor of, think of, I take your mile split at the 10-mile mark, and I see what your average mile pace was, and I project what your finish is going to be based on that. That's what a GDP tracker is. GDP is an aggregate statistic of all the other statistics, and all the statistics that have been released to date that go into GDP have been showing a 2.6% growth rate. Now, the data that's coming, and there's still half the data is not out yet, could slow down, it could speed up, and that could make it change quite a bit. But slowing from 5.3 to 2.6 is slowing from very strong growth to slightly above growth. That's a boom. That's not a soft landing. That's not a hard landing at all. Initial claims at 202,000, that's among the lowest numbers we've seen in the last 50 years. 199,000 on jobs, even though the 3-month rate has been coming down. That's way more than what economists think we need at 75 to 100,000 jobs to make up for population growth and net immigration. So this economy is looking like it's going to speed just fine. My fear is that we are in a new cycle and that this new cycle will spur, spending and will spur in stickier inflation. And the reason I say we're in a new cycle is people say, well, we had strong growth from 2010 to 2020 and it never showed up in inflation. But we did have strong growth in 21 and it showed up in inflation in 22. Now, some of that was transitory because of the constraints around the shutdown restart of the economy, which got us to 9%. But I don't think we're going all the way back to 2% here, that we're going to have some residual of that sticky inflation. And if you add on strong growth onto that this inflation problem will continue to percolate. So if we wind up with 2.5% inflation, real GDP growth, plus or minus 50 basis points, if we wind up with 3% inflation, 3 to 4% inflation, thereabouts. Remember, core inflation as we're recording is 4%, and headline inflation is 3% right now. If we stay in this range and add in 2.5% inflation, that's nominal GDP growth. Nominal is inflation plus real growth of 5 to 6%. That's where I get my 5.5% number from. That ultimately the economy should approximate what we expect nominal GDP growth to be. And if we're going to expect it to be 5 to 6%, I ultimately think interest rates are going to go back into that range.
So we're looking at 3.93 on the 10-year yield as of Monday afternoon. As you said, core inflation's at 4%. 4% is a bigger number, Jim, than 3.93 is. How can the Fed in this environment say, yeah, we need to cut rates to significantly below the inflation rate and also below the unemployment rate at the same time? Doesn't seem like
me. You got me. I mean, that's the word salad, right? You summarize the question very well. Jay, why do you think you need to be cutting rates, or at least talking about cutting rates when you've got those kind of numbers? Again, because the inflation rate's going to go down, because you've got such a good track record of predicting it for the last few years. You've got it figured out now. You've got it right. Dan Tarullo was a Fed governor from 2009 to 2017. And I like to joke that when Fed governors leave are the ones that you want to pay the most attention to. And right after he left, he gave a speech at the Brookings Institute in October of 2017. And he said that the Fed has no working theory on inflation, that they've looked at all the theories, they've looked at all the data, and they cannot really come up with an explanation for why inflation behaves the way it does. And by the way, I agree with them. It sounds like most people, oh, inflation's easy. You just look at the money supply numbers, or you just look at this, or you just look at that, and that go test it. Go test those theories. They don't work. Inflation is kind of its own independent animal unto itself. And so, yeah, if they're right about the inflation rate coming down to 2%, then everything they said makes sense. But if their forecast remains like the forecast that they've been giving us, wrong, then there could be very problematic as we go from here. And again, you hear a lot of people say, but every time we did this in 1990 or 2003 or 2014, there was no inflation. I will emphasize, I think this is a different cycle. And I'll give you one thing. I know I've been on this podcast with you many times before, and I've talked about work from home. I won't rehash that. But I will say that what you've been seeing with 22 months of under 4% unemployment, and that is the longest we've seen it go consecutively under 4% in 53 years. You got to go back to 1970. As I mentioned before, 200,000 on initial claims, one of the lowest numbers in 50 years, 199,000 on jobs. People feel pretty optimistic about their job. They treat their jobs very transactionally. Look, I'm going to do this job, but if I don't like it, I'll quit. I'll find another one, and I'm comfortable I can find another one. No less than the federal government. In the summer, the federal government made a big push to get all of the DC federal workers back into the office 4 days a week. So many of them quit or threatened to quit. They backed off of it, and they're still on 3 days a week right now. And what I'm saying is, if workers are comfortable with their job situation, look, I can get another job if I don't like this job, then honey, go ahead and book those tickets for the week in the Bahamas. I don't have to worry about it. I don't have to, what if I lose my job? Do we need to, maintain a higher cushion of savings? They're not in that mode right now. They're spending, and that's why the economy continues to stay resilient. And if it does, and they keep spending, they're going to start bidding things up. They're going to pay for those higher ticket prices. They're going to pay for those more expensive meals. And we're going to see it in the CPI numbers, which is what I think we have been seeing. As we get rid of the transitory inflation of 2021-22 from the lockdown restart, what we're seeing is when that dust settles, is we're at a higher level of stickier inflation between 3 and 4%.
Okay, I can't figure out how to even begin projecting what might happen next into 2024, because what you're telling me is, look, we've already got inflation at 4%, and despite the fact that unemployment is below 4% and the 10-year yield is below 4%, the Fed is embarking on with what you think is a lot of hidden division inside of the FOMC. You think there's a strong disagreement that's kind of being covered up. But what they're doing is they're telling us that there's going to be this rate cutting cycle of several cuts in 2024. Now, if that pushes inflation up, like you and I think, agree very strongly, it almost has to, then what happens is you get more and more division inside the Fed. If there are some politically motivated members who feel like the thing to do is just keep cutting into the election no matter what, and there's level-headed minds in the room that have been saying all along, look, inflation is starting to go out of control. We can't do this any longer. If they're going to cover up by not showing us the real division in the voting, so they're trying to make it look like there's always a unanimous vote. It seems to me like that's a setup for the market to have no idea what happens until the Fed's next mood swing occurs. Last Wednesday, Jim, a lot of people blew up on that announcement. There were a lot of leveraged trades that hedge funds had on that blew up and caused a huge amount of damage because it was a completely unexpected message that didn't seem to suit the circumstances of the economic data and the forward guidance that the Fed had given previously. It seems to me like you're telling me basically from now to the end of 2024, almost anything is possible. It's not really going to be clear what's driving it, and we won't find out until the actual meeting happens or the press statement happens. And looking at the economic data and trying to make macroeconomic sense of it and predict what the Fed's going to do next probably won't work. Am I missing anything there?
No, in fact, I would argue to you that that's exactly what's been happening since last Wednesday. As I mentioned earlier, you've got this litany of Fed officials coming out and saying, hold on, guys, nobody said anything about 6 rate cuts. We said 3, they're going with 6. And Bill Dudley is writing, you guys are taking a big risk. And what is the basis for all of this? No one knows what they're doing. No one understands. Maybe the market is pricing in what it wants, what it would like to see, or maybe the market thinks that if we kind of force the Fed's hand, that they'll cave and follow us as well. Because I don't think that they're being very clear, and that goes all the way back to the beginning of this interview with the word salad, or the phrase word salad, is that they're not clear. You're right, and this is what's going to happen, and this is why you not only you see the market react, you see it react violently when they surprise. And you could see it. Look, we forgot too that the market was reacting violently in the other direction in September and October when it saw very strong data. And now it's reacting violently to the Fed talking about ending rate cuts. And I suspect it will continue to react violently as we move forward from here. So, yeah, it is unclear. And a quick word about the Fed. Let me talk about the stock market real quick. On October 27th, the stock market, the S&P had closed 10% off of its July 19th high for its first 10% correction since the bottom in October of 22. That was 3 weeks into the fourth quarter. That was 3 weeks into third quarter earnings reports. Over half of the S&P companies had reported. They were largely good numbers, that the earnings numbers were pretty good. And while they were reporting one good number after another, like 250 to 280 companies were reporting good numbers, the S&P was going straight down. And it corrected 10% in the middle of all of those good numbers. Why? Because the 10-year yield went over 5%. Then on November 1st, Janet Yellen backed off on the quarterly refunding announcement by saying we won't issue as many notes and bonds, we'll issue more bills and a little bit less of that, and sparked an enormous rally in bonds, lowering interest rates, or lowering bond yields to be more specific. And the stock market took off. So let's understand the environment we're in. I could give you 280 decent earnings reports, or I could give you a bond rally. And right now the market is saying you could keep your earnings reports. I want a bond rally. So really the stock market seems to be reacting to the bond rally right now. So when the Fed starts hemming and hawing about we might have to cut rates, we're done raising rates, and the bond market takes off, you get this everything rally, which is exactly what everybody's been calling it. But the genesis of all of this is lower yields. And if sticky inflation and a strong economy upset that part of the equation, the lower yield thing, it's going to show up everywhere, I think, in 2024. Now, look, I could be wrong, and maybe the economy does slow down, and I could be wrong, and maybe the cycle isn't different this time, and that we are on a glide path back to 2%. But that's the risk you're taking. The risk you're taking is we're at 4% core, we're at 3% headline, close enough for government work. We're on our way to 2. Let's start the rally right now. Don't worry if everybody feels a little richer and might start spending money. They won't create demand for stuff that will push up inflation. That's the bet we're making. I don't think that's a good bet, but look, it could work out.
Yeah, because inflation never runs away in a self-reinforcing vicious cycle. That's never happened before. Let's come back to your 550 projection on the 10-year yield, because based on all the things you're saying, Jim, I don't even understand what time frame, if there is a time frame. Are you predicting that the things the Fed's trying to do, which are clearly oriented, if they're going to continue cutting, they're clearly oriented toward bringing yields down? Are you predicting that something breaks and they lose control, or are you predicting that the 550 doesn't happen until the Fed pivots back because inflation forced them to? How do we get from here to 550 yield on the 10-year?
I think it's because the Fed has to pivot back and then yields go up. And the example I'm using in my mind is what happened in March. If you remember March 7th, Jay Powell went to Congress and was very hawkish. And at that moment, the market was pricing in better than a 50% chance that the funds rate would be at 6% by September. That was March 7th, because he was just full hawk at that point, and we're not close to being done raising rates. The reason I bring up March 7th twice is the next day was Silicon Valley and Signature Bank and Silvergate Bank, bang, 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 all failed one right after the other. And then a month later was followed up by First Republic. You had an enormous rally in the bond market at that point. Yields on the 2-year note fell almost 100 basis points in a week back in March, because the feeling was the Fed had raised rates too much and something broke. And that was the banking system, because these banks are failing every day. And that's it. We're done with the rate hikes. It's all over with. But then the rally in the bond market continued for about 2 months, took yields down about 100 basis points. And then we realized things didn't break. And the Fed kept raising rates again in May and in July. And the economy started to heat up. And not only did we recover all of the decline in yields that we saw from the March 7th speech, but we went off into higher highs. So the market, I think right now they're back to the same kind of opinion, that the old adage that usually something breaks to cause a recession. If you ask people what is it that is causing things to break, it is higher interest rates is what they think is causing things to break, like they did in March. Oh, higher interest rates broke the banks, which is going to break the economy. I'm going to push back on that and say, I don't think interest rates are high enough yet in order to break things. And the reason I don't think they are is I think we've got an anchoring problem. We are so used to 15 years of QE and zero interest rates that we look at the current level of rates and we can't believe how high they are, and we think that everything's going to fall apart. Jonathan Gray is the CEO of Blackstone, a private equity firm that benefits from cheap money. And he didn't report good numbers in the third quarter. And he blamed it on high interest rates. And he said that these interest rates were unsustainably high and they were going to break things. Well, if you're a levered private equity firm that needs cheap money, I can understand your point of view. But I don't think we're really seeing the evidence that these high rates are hurting things. And I might add, if you go back to pre-2009, pre-QE, and look at real rates, mortgage rates, 10-year yields, corporate rates, these rates are still a little bit below those levels. And during that whole 2000s period before QE and in the 90s, economy did fine. We had a bull market in stocks and we had much, much higher interest rates. The problem is people can't remember that period. They just think that we've gone from 0 to 500 basis points or 5% on the funds rate, that's too much too fast. And I don't think that they realize that the distortion is not 5% yields now. It was 0 for the last 15 years was the distortion. Several hundred of those basis points was removing the previous distortion. And maybe we're not as nearly as injurious with the level of interest rates that everybody thinks they are. Monetary policy, we all like to say, works on long and variable lags, and everybody says, yes, they are. And the long and variable lags of raising rates is, and I'd like to say maybe the long and variable lags are still from 15 years of 0. We're still not past those long and variable lags before we talk about how much interest rates have gone up yet. I still think that they're not nearly as punishing as everybody thinks they are. Now, I know if there's somebody who works in the mortgage brokering business, they've got a different opinion because they're not getting any refi business, but that's not enough to hurt the entire economy. And I understand that it is not good if you're in the mortgage brokering business looking for refis. But, the broad swath of the economy is not nearly as injured by these rates as people think they are.
Jim, I want to pick up on this theme of interest rates going higher, not breaking things to various people's surprise. Because, if we go back to when we had 0 interest rates, what the doomsday bloggers were saying is, okay, look, someday we're going back to 5%. And because we have so much more national debt than we did last time we were at 5%, what's going to happen? You just wait. When we get to 5%, all of a sudden, the U.S. government's cost of debt service is going to exceed tax receipts, and you're going to see the U.S. national debt accumulate so quickly it'll be $1 trillion in a single calendar quarter. That's how fast we're talking about accumulating debt. That's what's going to happen, and it's going to be the end of the world. The sky is falling. Everything ends at that point. It's martial law. Well, the crazy thing, Jim, is every single part of that story actually happened, including the $1 trillion in a single calendar quarter. But it wasn't even considered newsworthy. Nothing happened. Nobody's even talking about it. So the idea that that was going to cause the end of the world clearly wasn't right. How far can you go? I mean, how many $1 trillion, trillion here, trillion there in a calendar quarter? When does that start to become a problem?
So they were correct in their prescription of, or their description of what was going to happen when rates went up, but in their prescription of what it meant, what was not incorporated into that is the federal government is paying out, $1 trillion a year in interest costs now, up from about 400 billion 2 years ago, and that number is going to go up again in 24 because as bonds mature, the Fed still has coupons that they issued with 2 and 3% coupon payments that will mature, and they're going to be reissued out with 4 and if their bills 5% coupon payments, and so that number is going to keep going up. Who's that paid to? That's paid to bondholders, and who are the majority of bondholders? No, it's not the Chinese. They're not the majority of bondholders. They only own about 15% of the debt. It's important, but it's only 15%. It's domestic people. It's income. And I think if you were to look at the data from companies, so first of all, the debt payment, let me finish with the debt payment of the federal government usually goes to bondholders, which tend to be the wealthy. So they're receiving more interest income. Companies is the same thing. What's this higher interest rate doing for companies? Well, one, companies have used the derivatives markets like swaps and stuff to term out their debt, to lock in their lower interest rate costs. So they're not really being impacted by it that much. Now, yes, that terming out is not forever. At some point, all that debt matures and they'll have to put it out at higher rates. But two, they have a lot of interest income that they're getting. They have a lot of cash. They had a lot of short-term securities that they're getting interest on that they weren't getting 2 years ago. Warren Buffett's Berkshire Hathaway has about $130 billion of cash. That $130 billion of cash 2 years ago was netting him zero interest payments, essentially. And now he's getting about $8 billion a year from that interest payment. So if you actually looked at the financial position of corporations since rates have gone up, it's gotten better. And it's gotten better because their interest income has gone up faster than their interest expense has gone up, largely because they've hedged it. And so they're improving their financial position because rates are going up. What about the individual? Well, that's kind of a sticky story. As I mentioned before, with federal government debt, it's owned by the wealthy. The wealthy, the top 10% of the country in terms of income, measuring it by income, owns about 90% of financial assets and owns about 98% of retirement assets. A lot of those assets are interest-based. They're getting more interest income. They're seeing home prices hold together. They're seeing stocks go back to all-time highs. They're doing fine. They're doing fine, and they're going up. But what about liabilities? What about mortgage interest rates and stuff? The unfortunate thing is, if you look at a breakdown from the Fed Survey of Consumer Finances, 56% of mortgage debt is held by the bottom 50% of the country. So it's unfair. Maybe it's not unfair, but it's a reality, is that the rich own the assets and they're benefiting from higher interest rates, and the poor own the liabilities and they're being hurt by higher interest rates. But the other stark reality is it's the rich that spend the money because they're the ones that have the money. So when we look at the economy continuing to move forward and those trips to the Bahamas and stuff like that, that's who's spending the money, and that's who's producing the GDP and the beat in retail sales that we saw last week, and is seeing the financial positions of the corporations that they either work at or invest in improving, and are hiring those 200,000 people a month. And so that's why the economy continues to be able to absorb these higher rates. Now, One thing that could really change that in a big way would be if we were to return to a steep yield curve where borrowing costs tend to be on the longer end of the yield curve and they go way up, and interest income, which tends to be shorter around cash, is far, far lower than borrowing costs. That could upset that apple cart. But what if we had for the last year and a half an inverted yield curve where short-term interest rates are higher than long-term interest rates? So interest incomes are rising faster than interest expenses. So that's one of the reasons why I say that these rates haven't really injured anybody, because Warren Buffett's making $8 billion more just because 5% is what the T-bill yield is right now, when it was 2 or 0, 2 years ago. And so when they look at the federal debt financing costs, they're missing what it's doing to corporations and people. One last thing about this too. I'll hear a lot of people say, well, the federal government can't handle it. It's going to put the federal government's fiscal situation in a terrible spot. Rates can't go up. They have to come down. The Fed has to cut rates because of the federal government's spot. This is what every over-levered person, whether they're an individual or hedge fund, says. I got too much debt. Please cut my rate to 0 so that I can handle my interest payment. Why? So then I could take out more debt and continue to do the same things that I was doing before. It's because the federal government has high levels of debt that is pushing those rates up. If the Fed was to say, no, we have to cut rates because interest costs to the federal government is becoming burdensome, they're going to borrow more. They're going to stimulate more, and we're going to have more inflation. That argument is backwards. You don't cut rates because you have too much debt, so you can support it and then add more stimulus on top of that. And you hear that argument quite a bit.
Jim, you mentioned the inversion of the bond yield curve. I'm not certain of this, but I think we might be at a record in terms of how long a yield curve inversion has lasted. Why is that? Why is this such a long inversion? And what's going to change it? When are we going to get back to a regular uninverted yield curve?
So it is a record if you measure it as the freely traded yield curve, that this is one of the longest. We did have it inverted longer in the 60s than we do now. And that's only because that was the era in the 50s and 60s. That was the era of Operation Twist, when the Fed set those interest rates and forced it to be inverted during that point. But more to the point about the inverted yield curve. One of the reasons that the yield curve, I think, has been inverted is it's been a market outlook, right? The Fed controls short-term interest rates. They're raising them because they were afraid about inflation to 5%, and T-bill yields and short-term interest rates follow them higher. 2-year notes follow them higher too because they're closely aligned with them. The market has been skeptical of the inflation story and has been worried that the Fed's going to break something. So long-term yields have been very slow to move in parallel up with those yields, and that's why you've had the inverted yield curve. Now, a lot of people like to talk about the inverted yield curve as being a signal of a recession. And it has been. It's been a perfect indicator, 8 for 8 in the last 8 recessions, going all the way back to 1970, the 1970 recession. Before that, its record was spotty. But then again, before that, the Fed was setting interest rates. There wasn't a freely traded market like we have now. Now that I said that, I think what we're learning is the yield curve inversions in the past didn't last very long, and that it's actually the uninversion of the yield curve that is the signal of a recession or a slowdown. And usually the way that the yield curve uninverts, you got higher short-term rates than long rates, it uninverts through a bull steepener. That's bond market talk for short-term interest rates plummet below long-term interest rates, and then the yield curve goes positive. What causes short-term interest rates to plummet? The Fed is panicking. The economy's in trouble and cutting rates like mad. You're not seeing that right now. Actually, since the Fed has been talking about cutting rates in the last couple of weeks, the yield curve has been getting more inverted. It's not been getting less inverted, at least by the 10-year, 2-year metric that I've been watching. It's back to minus 50 basis points, which it was at minus 25 or 30 a couple of weeks ago. So we're not seeing that yet. So when will the yield curve uninvert? is when I think we are really, truly in a period of a slowdown that is going to truly put to rest the inflation story. Then you'll see short-term interest rates plummet below long-term interest rates and then uninvert and steepen the yield curve. That's not happening now. What's happening is they're both parallel shifting down, with short-term rates actually falling a little bit, short-term rates being a little bit sticky as long-term rates go down, and creating more of an inversion in the curve. And I interpret that as that maybe there's a little bit of a lingering doubt in the market about this idea that we're going to get inflation back to 2%. We're going to have a soft landing. I mean, it's not a total doubt about it, but there is some that the yield curve is not behaving the way it should have if you really thought we were going to have this proverbial soft landing 2% inflation.
I've focused this interview so far on the bond market because that's your specialty, but let's quickly just touch on how that extends to the equity market, because a lot of people had the view that, okay, look, there's a good setup here for a Santa Claus rally into year end. Fade that, because, you know, all the smart money's already figured out that this thing's coming to an end. Well, okay, hang on. That was before the word salad and the Fed kind of changing its mind. What do we make, or what do you make at this point of the outlook for equity markets given this change from the Fed?
So I think, as I mentioned earlier, the thing that's really driving everything is yields. Like I said before, you could give you 280 decent earnings reports, or I could give you a bond rally, and the bond rally is what makes stocks take off. So if my scenario of the economy stays stronger, inflation stays stickier, yields eventually turn around sometime in the, say, middle-ish of 24, start looking like maybe 5.5 looks more like a reality than it does today, I think that the stock market will have somewhat of a problem with that. Not a devastating bear market problem like it would with a hard landing, but like we saw for most of 2023, except for the Magnificent Seven stocks, they really all just really meandered sideways and didn't do a whole lot of anything until the bond rally started in October. And then all of a sudden, everything started to take off. Now, why is that? Dr. Jeremy Siegel wrote the book Stocks for the Long Run. Fantastic book, one of the greatest investment books ever written. And he put out a new edition of the book this year. In that edition, and I'll just summarize it, looking at the Shiller PE and looking at where the valuation is of the market and everything else, the historical trends suggest that you should expect about an 8% return from the stock market long term. Look, the last 2 years, your return's been zero. Maybe be a little bit better in the future, but longer term, it'll go up, it'll go down. You'll get an 8% return. Right now, you can get 5 in a money market fund. Money market yields are still above 5. So you could get 5.8, 62% of that expected long-term return by taking no market risk. A money market fund does not have market risk. And so the question then becomes, what's going to get you to take that other third? And this is not 2019. 2019, maybe the return in the stock market long-term was 8% too, but your alternative was 0 in a money market fund. And that's why we coined the term TINA. There is no alternative. There is an alternative now. I can get most of the stock market's gain without much risk in cash. And I might add, what's going to get me to take that risk on the final third? I've got this heterodox opinion that this is the era of the stock picker. The stock picker is coming back. It's no longer, do I buy IWM, the Russell 2000 index, or do I buy RSP, the S&P equal weight index, or do I buy SPY or VOO, the S&P market cap indexes? This is, what stocks do I buy? What themes do I play? I should have been playing the AI theme in 23 is what I should have been doing. And that we're going to transition away from just buying indexes to buying individual stocks. Now, the indexes worked because it was the mega cap companies that pulled the whole index up. But there could be a time in the future where 492 stocks are up 15% for the year, but the mega caps are down, so the S&P is unchanged on the year. And you could have randomly done the Dave Portnoy thing and picked letters out of a scramble bag and beaten the S&P. This year's been the opposite of that, but you could see that coming soon, in the market. So if rates start back up, that is a powerful headwind, I think, for the stock market as we go forward from here. Is it a headwind that produces a bear market? No. Is it a headwind that produces kind of what we saw in the beginning of this year? A frustration, a bunch of sidewaysness, except for 7 stocks? Yes. But then, the retort I hear from people is, well, who cares about all that analysis? Just buy the indexes because they went up. They went up because of 7 stocks. You better hope that those 7 stocks, which are 30% of the index now, continue to go higher. Otherwise, the index might suffer. And if you're not picking stocks, you're going to miss out on the opportunities going forward from here. So what's it mean for the stock market if my scenario plays out? Is a headwind for it because of the competition of rates, where I could see people saying, you got to invest in the SPY because it's got this 8% long-term chance. And I'm getting 5. It's good enough for me. I don't want to take the extra risk. I can sleep at night. It's not 2019 when the alternative was 0.
Jim, I want to move on, believe it or not, to Bitcoin, because yours is one of the few voices in finance that I really respect on crypto. Something a lot of people are talking about is it looks like they're going to approve the Bitcoin ETFs. We already had some ETFs for the futures market, but now the spot Bitcoin market, it looks like the ETFs will be approved for that. What should we make of that? A lot of people are saying that's going to bring institutional capital in and it's to the moon for Bitcoin. It seems to me like everybody's front running it already. I wonder if it's a sell the news event.
I agree with that. I'm worried. I should say I'm worried that it is a sell the news event. First of all, a couple of things that I'm assuming. I am assuming that the Bitcoin ETF will be approved. And not just a Bitcoin ETF, but we saw this with the Ethereum futures ETF a couple of months ago. The SEC knows that there's a gigantic first mover advantage. He who goes first wins. And when you bring in a new category of ETFs. So what they did with the Ethereum ETFs was there was 9 of them. They approved all 9 of them on the same day. I suspect that some people are pointing at January 8th as being one day, that they're going to approve all of the spot Bitcoin ETFs on the same day. So therefore, no one is accused of, I approved the BlackRock one, but not the other ones. So I gave BlackRock an unfair advantage at going first. They're going to just approve them all. I suspect that they are going to approve them all. You've seen a lot of people talk about, well, this is going to be the thing that's going to drag a lot of institutions into the market, and X billions of dollars is going to come into the market, and that's going to drive prices higher. Yeah, and it already has. And the prices have doubled in the last, several months, from under 20,000, actually more than doubled, to a little over 40,000. So I think that expectation of what that adoption is going to mean is in the price. And I fear that it could be a sell the news event when it does happen. But I also have another bigger fear. And I might add, I'm bullish generally on the idea of crypto, and I'm bullish on decentralized finance, and I have been for many years. But I think I'm best off telling you about what my concerns are. And if I can alleviate my concerns, I can really get even more behind it, even though I am behind it to begin with. So my first one is that this is a sell the news event. My second one is, we need the Bitcoin spot ETF where it buys physical Bitcoin and not futures in a regulated brokerage account like your Schwab account, just to pick a name, to buy an ETF that's listed on the New York Stock Exchange or the NASDAQ that owns Bitcoin, somewhat similar to the Grayscale Trust, but without all of the discount premium that a closed-end trust has. Well, I thought that the whole idea, why I was so positive and optimistic about cryptocurrency, was decentralization, permissionless and censorship, that no one can permission your money or censor your money. No one can manipulate either the growth rate of the number of Bitcoins or who can do what with it. And that was the promise of digital cryptocurrencies via the blockchain, was that no one could control it. But if the answer is, no, we're going to get everybody to buy these on regulated brokerage firms through regulated investment products on regulated exchanges, then they are going to be permissioned and they are going to be censored and they are going to be controlled. And then I'll turn to my crypto friends and go, what have we accomplished? We just created a digital version of what already exists. I thought the whole idea was to create something new and something that was outside of the reach of the regulator and the central bank and the government from manipulating to their ends. And so I worry that if we think that this is the home run that we've all been waiting for in these Bitcoin ETF, I'm worried that we're missing the narrative here, and that this might not be the best thing in the world long term for what we're trying to accomplish with. Oh yeah, it's been great short term, and maybe I'm wrong on the sell the news thing. Although, man, all the projections that everybody hoped for because of the Bitcoin ETF has already come to pass. But in the long run, is this going to get people to say, I need to consider new ways of getting faster transaction speeds, more decentralization, getting a wider net of these things, getting the technology getting to be better so it's not hacked or anything else? Or is this, I just throw my feet up in the air and say, everybody buy the Bitcoin ETF and shove and take my bags, my coins, and push them up in price. And that's all I really want. I just want number go up. So that's kind of where I'm thinking about with it. And that's what my two concerns are: the sell the news event, and I want it to be decentralized and permissionless and not censorship. And I see it going into products that can be permissioned and can be censored. And I don't think that that's good for the whole ecosystem in the long run.
Jim, it seems to me like there's another really big conflicting signal here, which is you've got the U.S. government. First of all, Liz Warren's on, this campaign to outlaw Bitcoin. She's worried about criminals and money laundering and so forth. Frankly, I think that they're missing the real story. The reason the U.S. government ought to be trying much harder to outlaw Bitcoin is because it legitimately provides competition for government-issued money, and it's competition which is superior in many ways to fiat currency. If the government wants to protect its monopoly over issuing money, then they ought to be trying to outlaw cryptocurrencies. But now you've got the SEC in your prediction, maybe on a single day, authorizing, not just one, but half a dozen or more ETFs, and most of the financial institutions, the major brokerages in the United States, have really started to market crypto pretty heavily. They're encouraging people to hold crypto assets in their retirement funds. There's various vehicles now for having your IRA or your 401k can have crypto in it. It seems to me like you can't possibly announce a government ban on Bitcoin after you've had the whole financial system upgraded to support it with the full blessings of the SEC. Are we getting to a point where the U.S. government will be unable to protect its monopoly because they've already kind of put their foot in their mouth by authorizing all these ETFs?
Yeah, I think we're already past that point right now. And I agree with you. You said it better than maybe I said it, is that, cryptocurrency has the potential and the promise to be a better form of money than what governments issue. And I want to see them continue to move that way and not just settle on being part of the existing system. And that's really what I think is behind some of the concern in Washington about cryptocurrency, that it has the potential to be a better form of money. They could try and ban it under that auspice, but they don't want to. The other problem they also have, too, is while Liz Warren is against it and some others are against it, there's big swaths of the Republican Party that are not against it right now. And they've been very pro-crypto. So it is a bipartisan thing. And it's really kind of a funky bipartisan thing. It's Republicans tend to be more pro-crypto than some of the Democrats are. But the biggest consumer of crypto tends to be the young that tend to vote more Democrat and not Republican. So it's kind of really a funky kind of product in terms of how Washington is coming down on it and who's defending who in this scenario. But yeah, I do think we are past that point where governments can ban it. And I also think we've also passed that point too, because I think what we ought to talk, most people listening to us are going to be either in the United States, Canada, or Europe, and we are at the apex of the financial system. We have a financial system that has rule of law, that has some transparency, that we trust, and we don't go to bed at night worrying about the health of our bank or that the government might seize our money in the bank. But most of the people tonight that will go to bed around the world don't have that same privilege. Their financial systems are either non-existent or very corrupt, or they're susceptible to fraud and abuse, and they worry a lot about that. They could benefit greatly from something that cryptocurrency is promising and is building towards right now. So we could ban it in the United States. We could ban it in Europe if we so elected to. Although in the UK, Rishi Sunak, the UK Prime Minister, seems to be very pro-crypto, at least for the moment. But in large swaths of Africa, Asia, and Latin America, this can provide a real source of stable money and medians of exchange for people. Now, I'm using these forward-looking words because I don't think we're quite there yet, but we're on our way. But if we just throw our feet again up on the desk and say, "Hey, we got the ETF and it's pushing all the prices of the tokens and the coins up, and that's all we really need. Thank you very much." We're never going to get there. And like I said, then what have we accomplished?
Jim, on the topic of ETFs, I want to move on to even more exciting news. You've introduced your own index, the Bianco Research Total Return Index, and it is expected, right now we're recording this interview on Monday afternoon, but by the time our listeners hear this on Thursday, it's expected on Wednesday that WisdomTree is going to launch an ETF to track your index. Tell us a little bit more about that, how it came about, what does the index track, and who would benefit from investing in WisdomTree's ETF, which tracks your index.
Yeah, well, thanks for bringing it up. And, so this ticker is going to be WT for WisdomTree, BN for Bianco, WTBN. It should be traded by the middle part of this week. It will track the Bianco Research Total Return, Fixed Income Total Return Index. Just so people understand, I'm in the index business with this index, like S&P is in the index business with the S&P 500. WisdomTree has an ETF that will track my index, like Vanguard and BlackRock have, and others, lots of others, have ETFs that track the S&P 500. S&P is not in the ETF business any more than I am. Now, my index, most people, when they look at, trying to beat an index, they say no one can do it. 95% of funds outperform indexes. And that's true in the equity market. The S&P 500 beats 95% of managers. But in the fixed income market, it's not the case. The index is where you would have thought it would be. It's around the middle. It's around the 50th percentile. So there is a lot of ways that you can outperform the index. So my index is going to be long only. So I'm always invested in the fixed income market. And we are going to tilt it. We've identified 5 factors that help to lead to, fixed income outperformance. Your duration, whether you're long or short the market, you're betting on rates are going up or down. Your yield curve bet. Do you think that the yield curve is going to be inverted or it's going to, steepen? Your credit. How much credit do you own in your fund? Structure or volatility, that would be like mortgages, how much volatility you have in your fund. And then a 5th factor that we've put into it, which is out of index bet, like whether you own munis or preferreds, or in the case where our index currently is right now, is we have a 20% weighting in our index in TIPS securities, Treasury inflation protected securities, because of the big real yield, and in short-term TIPS yields as well. We have a website, Bianco Advisors. Bianco Research is my research site, biancoadvisors.com, where you could see all of the way that the index is broken down and the way that it's structured. Currently, as we're talking right now, the index is it's positioned for the eventual launch of this ETF. It's positioned slightly underweight its benchmark, thinking that rates might continue to go low. And I try to take a 1-year look forward with positioning. So when I talk about these positions, I'm talking about over the next year. Slightly underweight duration, meaning that we're biased towards higher interest rates. We're somewhat neutral on the shape of the yield curve because I'm not sure which way the yield curve is going to go. We're slightly underweight, slightly like 91% of our benchmark. We have a benchmark. We're slightly underweight in corporates. We're slightly underweight in mortgages because of the high volatility in the bond market. And we're overweight in Treasury inflation protected securities. BiancoAdvisors.com, it lays this all out. the day this podcast, comes out, I will have hosted a conference call on YouTube page or live stream webcast on our YouTube page explaining all of this in detail, but there will be a replay available on the Bianco Research YouTube page and probably on my Twitter feed and on my LinkedIn feed as well too. So thanks for bringing it up.
Okay, so the ticker symbol for the ETF is WTBN, Whiskey Tango Bravo November. And in order to get the full briefing from Jim on what it's all about and where it's headed, you want to go to YouTube and type in Bianco Research in order to find the replay of a Thursday morning webinar that's going to explain all of this. Jim, I can't thank you enough for a terrific interview. Before I let you go, just also give us your Twitter handle and anything else people need to follow your work.
So all of the handles are not Bianco Advisors, but they're Bianco Research. So it's Bianco Research, at Bianco Research is Twitter. You can follow me on LinkedIn at Jim Bianco. As we mentioned before, Bianco Research, we are active on YouTube as well with a lot of videos there. Those are probably the big three ones. You can also look up Bianco Advisors, and you can look up biancoresearch.com as well. That's our research site. Thank you.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at macrovoices.com. Energy Transition Crisis, my new video documentary series about energy transition, has finally been released, and anyone can watch it for free at energytransitioncrisis.org. The series explains exactly what it's really going to take to break humanity's addiction to fossil fuels and why it will take longer and cost more than almost anyone realizes. And I'd like to think the 3 episodes on nuclear energy are among the most detailed on YouTube. This is a passion project for me, and there's no profit motive, no revenue, and therefore no budget other than donations. I'd really appreciate your help promoting the series. Things you can do to help include subscribing to the Energy Crisis Doc YouTube channel, liking every episode, posting comments on YouTube, and posting links to your favorite episodes on social media. If you don't have time to do those things, there's also a donations page at energytransitioncrisis.org. The money does not go to me. 100% of it will be spent on YouTube and other social media advertising to promote the series. Thanks in advance for your help. Now let's get back to the show and Patrick's postgame chart deck.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, great interview with Jim. Any takeaways you have to share in reaction to the interview?
Patrick, I think we've entered a dangerous new market paradigm in which Fed policy is going to drive all the action in risk assets, and it's going to be a guessing game as to what that policy really is, when the next FOMC mood swing will come, and how that will affect markets. I think Jim's speculation that Powell did the opposite of what he wanted to do because of pressure from Biden-appointed FOMC members in an election year is entirely plausible. But that still doesn't tell us what's going to come next. Presumably, the political pressure from some voting members will continue as they hope to keep markets and the economy propped up through the election. But even if Jim is right, we still don't know how many FOMC voting members are in the politically compromised camp, nor do we know what it would take in terms of contrary macro data to pull the FOMC back out of making decisions based on politics and into making decisions based on the data. So I think that for now, the new backdrop is wildly bullish for most risk assets, and particularly stocks and gold, but that could reverse on a dime at any moment based on factors that we don't know and can't know. All in all, if that's really what's going on, I think it means we could have a very volatile ride in markets through the November election, where nobody's hedged for the next event because the macro data are no longer a useful prognosticator of what those events will be. And guessing the FOMC's next move is only going to get harder and harder as we get closer to the election, and they're driven more and more by politics than economic data. And if they do keep the market propped up all the way through the November elections with excessively dovish monetary policy, inflation is going to run away again, and we'll have a real mess on our hands after the inflation. So it came as no surprise to me that nobody seems to be able to explain exactly what caused the dramatic sell-off in stocks on Wednesday afternoon. If markets are no longer driven by economic data, it's going to be a guessing game, plain and simple. And thin liquidity through year-end will only amplify that risk. We used to make fun of other countries when their markets worked this way.
Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you'll find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the button over Jim's picture saying, looking for the downloads. Now, Erik, let's cover crude oil starting with the EIA inventory.
EIA printed a build this week of 2.9 million barrels, Cushing, Oklahoma building 1.7 million barrels, gasoline building 2.7 million barrels, distillates 1.5 million barrels, again a build. So it's builds across the board. Meanwhile, U.S. production ticked up 2 ticks to 13.3 million barrels. That is an all-time record high. It's not the first time we've been at 13.3. We've been there before, but we've never been to 13.4 so far as I know. So this is back to the prior all-time high. Shipping disruptions in the Red Sea and a U.S. military strike on the Houthis, who were believed to be responsible for those attacks on ships in the Red Sea, have the market on edge about the possibility of a geopolitical escalation. When I taped last week's show, we were still just barely below $70 WTI, and I said we really needed to get above $80 before we could declare a new uptrend to be in play. Well, we got halfway there this week with the market briefly trading over $75 early on Wednesday, but we still have a long way to go before we could say the trend has reversed. At this point, with more and more signs emerging that the Biden administration is focusing its policy decisions on election year politics, I don't think the U.S. will do anything aggressive to risk another upside oil price dislocation before the election. And for now, at least, the supply constraints that I and many other analysts have been concerned with have not materialized in the data, suggesting that more black market oil is in the system than official statistics reveal. There's definitely a vulnerability, though, here in the sense that enemies of the United States understand the Biden administration's hesitance to risk higher oil prices in an election year. So I think the risk of geopolitical escalation being provoked by Venezuela or in the Middle East, not by the U.S., but by other parties who know that the U.S. is going to be slow to respond, is probably higher than some analysts perceive. But the bottom line remains that the Biden administration has a very strong incentive to do anything it can to avoid higher gasoline prices, and I think that's what they're going to do.
Yeah, Erik, that $75 level was much more of a focus for me. The 80, I certainly agree, would be that if we manage to beat the $75, $76 area, there's a fib retracement zone, the 50-day moving average, all sorts of things that are typical resistance levels. And if the primary downtrend of crude oil is not over, this would be a typical place for oil to roll over and, let's say, go and retest the lows or something of that nature. So this is an important make it or break it moment. If the bulls really are transitioning this to a new bull trend, a move to 80 and then consolidations that stay above 75 would be where a lot of technicians will be getting buy signals, and it could change the trend on crude from there. Anyway, Nick, I want to get you in this conversation. Let's talk about equities. What levels are you watching on the S&P here going into the holiday week?
Yeah, Patrick. So right now, the spot price on SPX is approximately 4,700. We have a call wall above at 4,800 and a put wall right where we're at right now at 4,700. The implied move for the January 19th monthly OPEX is plus minus 120 points. This denotes an upper expected move of 48.20, which is right around the all-time highs, and a lower expected move of 45.80. Right now, key resistance is above at 4,800, and key support is right where we're at right now at 4,700. Again, I mentioned last week I thought we would test out that 46.90 area, and we're almost there right now, possibly as low as 45.90. I think that's still in the cards. Yesterday, we had a very sharp sell-off from 47.75 all the way down to 46.95 area. So that didn't really surprise me at all. I expected at some point in time we'd see a volatility event. There was no actual reason for that. I heard speculation perhaps that a hedge fund was offside shorting 0DTE puts on SPX. Possible reason why, because we had a very, very rapid sell-off into close yesterday. Again, I'm inclined to think that we see some more upside back to that 48.50 mark, perhaps, new all-time highs. before seeing some downside after the January OPEX. What are your thoughts?
Yeah, listen, overall, the S&P 500, I think, is like in the 7th, 8th innings of the advanced part, which is that we're reaching all-time highs. We're very overbought. And this is a typical place where the market tends to pause and retrace or backfill or consolidate the advance. Very similar to November and December of 2021, where the last major high occurred. It spent over 2 months just more or less trading sideways before ultimately the market turned. And so in my mind, while we are certainly reaching overhead resistance, it doesn't mean that the downside window is going to open in any way. With us being in the middle of the holiday period, I would expect that this is going to start behaving far more trade range bound as we move forward. What's interesting though, Nick, is on page 5, I put the percentage of stocks above their 50-day moving averages on the New York Stock Exchange. It's just a way of observing the breadth of the market. And when we had this chart up several months ago in October, we were talking about how incredibly oversold the market was, because obviously back then only the fangs were working, the breadth of the market was horrible, and that ended up being a level that marked the swing low or the short-term low of the market. And then what you can see now in the last 2 months, we've seen the exact opposite. We've literally now come to some of the most extreme overbought readings based on this metric. And typically, even though that doesn't mark a specific top to the day, this just depicts the fact that this market has already had this bullish impulse and it's likely to pause and reverse at some point. The bigger question, if it does pause and reverse, is it just going to be a typical correction, or is there something going to happen that's bigger? Overall, though, Nick, I think that if there was going to be something that's more pronounced to the downside, it's probably going to wait for the first few weeks of January, and it's likely that the next 1 or 2 weeks is going to be far more like watching paint dry.
Yeah, I'm definitely in agreement. I think the last few weeks of the year and the first couple of weeks of January will be pretty dry as well as we head into that monthly OPEX. I think following that OPEX, we're going to see a lot of volatility, possibly a decline of 5% plus across major indices, especially in tech, which we're on to right now. So spot price right now in Qs is 405. There's a call wall above at 410 and a put wall just below at 400. Now, the implied move for the monthly OPEX for January 19th is plus minus 14 points. Therefore, the upper implied move is 419. The lower implied move is 391. We currently have key resistance right now at 410, which are all-time highs, and key support below at 400. As I said in previous weeks, I do think tech is overextended. Obviously, I think with it at all-time highs, I've been wrong. But the key point that I've been making is that the small caps are the ones that are undervalued and are outperforming, which they are. Look at IWM. I think that's where you want to place your bets, perhaps into January OPEX and not into big tech. The reason being is that I feel like big tech is very, very overbought. I feel like most funds are over allocated on these names, and they're going to sell them off in the new year in favor of buying the small caps.
Well, you know what? I want to move on and talk about volatility because while there was obviously a big downdraft on an intraday basis yesterday, the interesting part was the VIX did react, but it's still at incredibly low levels. I mean, we're at the 13 handle, which is a level where we spent most of the last month. And so it'll be interesting to see whether or not this correction actually spurs something much more in the mid-teens on the upside. How are you taking the VIX here?
So I figured the VIX at 12 was pretty low overall. Again, it could stay there for a few weeks, but at some point in time, we're going to get some exogenous event that's going to cause a pop. Yesterday, there was no actual reason for the pop in the VIX. But that being said, when the market is up almost 10 days in a row, you can expect that at some point in time, there will be some sellers to come out and sell off heavily, right? And all it takes is some selling to push us lower. And with the gamma flip on the put side, that can cause an exacerbation of the move to the downside. So for example, with the 0DT puts yesterday, there were some 47.50 puts that were only 15 cents leading up to close. What happened into close there? We fell, they went in the money, and those puts expired worth $55 each. So that's a crazy, crazy exaggerated move to the downside. And what happens is that once those puts get in the money, market makers are forced to cover their positions and essentially hedge against those short puts that are going to expire and cash settle. they're forced to therefore short futures, which pushes the market down even further. So it's kind of the opposite effect of what we've seen the last few weeks, where we've seen a grind higher and calls go in the money. Market makers buy S&P futures, pushing it higher, and there's no sellers at all, right? So total opposite effect. I think the VIX is still very low overall, and into January, February OPEXs, I think we're going to see a pop towards 16 or so. That's why I think it's very, very risky to sell short-term options. I've been saying this the past few weeks. Selling premium is not a good idea when the VIX is low.
Yeah, it's interesting. Like the one-day volatility index actually had a pretty significant pop, though. I mean, we were down in the single digits and now had a quick pop toward the 14, 15 level. Anyway, Nick, I wanted to move on and just touch on the dollar index. And what's interesting to me is the dollar is clearly still in distribution mode. The lower highs, lower lows, every time it pops a little bit, it comes right back down. I think the window remains open to retesting the bottom end of the range of 2023 down in the 100 to 101 range. The bigger question with the way that the Fed has advertised and their dovish position, it's going to be interesting to see whether that creates a much more prolonged, pronounced distribution cycle in the dollar that may even see it go under 100, or will the dollar generally fade this weakness? Right now, going into this holiday period, I see some downside risk, but as we approach that 101, 100 level, it'd be interesting to see whether a more meaningful short-term low is established.
Now, moving on to page 9, we have the gold futures chart. Erik, what are your thoughts here?
There's a very clear resistance level at 2063 on the February contract, and the market has bumped its head on that level several times this week. The chart point resistance is clustered between 2063 and 2085. So if we can get above 2085, the move should accelerate to the upside. And so long as the Fed doesn't have another public display of mood swing, so to speak, I think the fundamentals are supportive to eventually break through that resistance band and move higher. But the slow stochastics that were badly oversold next week are now back to just modestly overbought. So any sign of mood change from the Fed could easily bring on a sharp downside correction. Gold corrected downward in sympathy with equities on Wednesday afternoon, but not as deeply. So for now at least, the FOMC dovish pivot narrative is still in play for gold, and maybe it's still in play for equities. We'll see what happens. Anyway, let's see if it holds.
For me, I'm keeping this super simple. All these major highs were in that 2075 to 2085 level. And if gold is ready to make a more meaningful breakout to, let's say, 2300, it's got to clear that hurdle. And right now, we've been week after week just consolidating below it. And we haven't seen that real breakout that is going to advertising that next leg. But with the fact that the dollar is as weak as it is, I still leave the window open for a breakout, but that's the key hurdle, and we're going to watch to see if it breaks.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview and the chart book, which is discussed in the postgame, including a number of links to articles that we found really interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter @Erik S. Townsend. That is Erik spelled with a K, and follow Patrick @Patrick Ceresna. On behalf of Erik Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com. the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.